Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Welcome back, everybody, to another episode of the Live Big podcast. We are going to continue our topic from our last episode and talk a little bit more about kind of the tax advantages. More specifically, in this episode, we will be talking about 1031 exchange and the exchange of real estate and rental properties, investment properties. So first, I want to start just with a quick quick definition of what a 1031 exchange is. So first of all, just the name in itself comes from the United States Internal Revenue Code. It is section 1031. And so it basically says in so many words that a taxpayer may defer the recognition of capital gains and related federal income tax liability on the exchange of certain types of property. Okay. Now, somewhat more recently, I believe it was in 2018, this section technically only applies to real estate assets. So it doesn't apply to like the exchange of stock in trade or inventory or things like that, which I think previously could be done. But so we're going to focus more on just the real estate piece. So to start with kind of the basics of a 1031 exchange, the idea is that when you own a property, and we're not with this last episode, we talked about people who were taking advantage of a personal property exemption. So it's where the property you own and that you occupy is being sold. That is a personal property exemption. In this case, we're talking about investment property where you don't live, and how you can defer the tax and kind of kick the can down the road, so to speak, as far as when you are going to pay taxes on the sale of these properties. Okay. The overall idea here, and I want to make this big picture so it shows really the value here. But let's say you were going to exchange a property that was, let's say you had a $16 million apartment complex, and you wanted to exchange it into a $20 million apartment complex or a $20 million commercial building, somewhere else. The idea here would be that when you sell that property, and let's say you bought the initial property for $10 million, you would have $6 million in capital gains on that first property. The taxes on that capital gains would be somewhere in the neighborhood of like $2.5 million, or right around $2 million, $2 to $2.5 million. So instead of now, let's say you own that property outright. If you own the property for $16 million and you sold it, and let's say that was your total net after paying real estate fees and title fees and all that kind of stuff. So you make $16 million on the property, you're going to have that tax liability on the gain of $6 million. So now instead of having $16 million to reinvest, you really only have $14 million to reinvest. So the difference here is pretty significant. You now have the ability to take those extra $2 million that you should have paid in taxes, and by deferring that tax burden, you can actually buy more real estate, right? And so the idea here with 1031 is to allow for the acquisition of more real estate. And some of the rules that apply for this particular exchange of property, there's a couple of things that we have to make sure that we do to fully defer the capital gain or recapture the tax. Okay, so the first one has to be that you have to acquire what's considered to be a like-kind replacement property, and it has to be held for investment use. And so it has to be a piece of property for a piece of property. You can go residential to commercial, you can go apartment to office, but it does have to be real estate to real estate. Okay. So you can't like exchange a piece of property for like a painting, for example. Okay. The second piece is that the purchase of the replacement property has to be of equal or greater value. Okay. So if you're selling a $500,000 property, the property that you're going into has to be at least $500,000. And the reason for this rule is that if you did this tax deferment, and let's say you started with one $500,000 property and you kept exchanging all the way up to say $10 million worth of real estate and deferred all this tax, and they let you start buying down. Now you go to 9 million, 8 million, 7 million, all the way back down to 500,000, you would eventually wipe out your tax burden altogether. Okay. So the idea is you're only doing this to move up. Okay. So you purchase a replacement property of equal or greater value. And then the next piece is that you do have to reinvest all of the equity into the replacement property. Okay. So if you sell your $500,000 property and you pull $300,000 from that, all $300,000 has to be invested. Now, if you don't do that, you qualify for basically a partial, you can still do like a partial exchange. Okay. So what's going to happen is they're going to tax you on whatever you don't reinvest. So let's say you take that $300,000 gain that you make from the property and you decide, I want to keep 100,000 of it and then reinvest the other 200,000. The $100,000, some people have this misconception. They'll be like, well, I spent $100,000 to buy that property in the first place. So I want to get my, so to speak, my principal back and just reinvest the gain. You can't do that. So unfortunately, kind of your first money in is your first money out. Okay. So if you put $100,000 into a $500,000 property and then you sell it with a $200,000 gain for a total of $300,000, the $100,000 that you whatever money you reinvest is going to be that same $100,000 first, and then the deferment last. So the tax, whatever would be the capital gain last. So if you decide to hold back 100,000, they're going to look at that as you holding back $100,000 worth of gain, and they're going to tax you on it. Okay. That's what we call boot. So when you hear the term, when you're looking at, a 1031 exchange, if you hear the term boot is any basically leftover money or any money that is taxable based on your exchange. Right. So, the other thing that you have to do is you have to obtain either the same or greater debt on the replacement property. So again, if you've got a $500,000 property and you have $200,000 in debt left on it, so on a loan, your new property that you exchange into has to have at least that debt as well. Okay. So now, debt could be replaced with additional cash. So let's say you wanted to go into something. Let's say you were going to exchange a $500,000 property for another $500,000 property. Your loan amount was $200,000. You would generally have to have at least a loan of $200,000. But if you didn't want to have a loan, if you wanted to own that property outright, you could infuse another $200,000 in cash and replace that debt with additional cash. Okay. But you cannot have cash equity replaced with additional debt. Okay. So, and then the other thing is you can't exchange, you can't receive cash or like any other material benefit from the sale proceeds during the exchange. So there's like you can't really remove material benefit from the exchange. Okay. So that's kind of the basics of a 1031 exchange. From a logistical standpoint, the way a 1031 exchange takes place is essentially the government looks at it, the IRS looks at it and says, okay, if the funds from the sale of your property touch your bank account, they're yours and we're going to tax you on it. So what happens is we hire what we call a qualified intermediary. That qualified intermediary is like a third party that sits in between what we would call the relinquished property, which is the property that we're selling, and the replacement property, which is what we're moving up to. When we sell the relinquished property, what happens is the funds from that relinquished property get moved over to the qualified intermediary and they hold those in escrow. And then when you take the replacement property and you purchase it, the qualified intermediary will wire those funds or send those funds to the closing table for the new property that you're acquiring. Therefore, the funds never touch you as a person or end up in your bank account. Okay. And that's what allows us to kind of go through this period. Again, another logistical piece of the 1031 exchange, there are regulations on how this 1031 exchange takes place. So the biggest one is a timeline. So when you close on your first property, again, we call it the relinquished property. When you close on that, the clock starts. Okay, so the closing of your first property starts, and now you have what we call an identification period. Your identification period is 45 days. So you have 45 days to identify the property that you want to purchase, and then you have 180 days total. So that's an additional 135 days after the identification period to close on the replacement property, and really to close on the last replacement property. So if you're exchanging into multiple properties, you need to close on all of those properties during that 180-day period. Okay. And you also need to identify those properties in that 45-day period. Okay. If you're exchanging one property for one property, it's a little bit easier because you're just identifying one property, and then you're doing and then as long as you close within those 180 days, you're good. However, we run into some other rules, and we get into the weeds a little bit with this. And so if you're looking at executing a 1031 exchange, make sure that you're working with somebody who understands 1031 exchanges, working with a company already that's a qualified intermediary that can give you guidance on this. And a real estate broker understands the process of a 1031 exchange. Okay. But basically what happens is exchangers can identify more than one property. Like, let's say you identify a property within the first 45 days and you get under contract, and then something comes up and you fail contract. And let's say that failure of contract is after the 45 days. If you don't have another property already identified, your exchange is going to fail and you're going to owe capital gains tax. So it's very important when you're exchanging a property that not only do you get maybe one under contract, but you also put one kind of in a backup position, so that in the event that one of the deals fails, you still have a backup. Okay, so the flexibility that the IRS gives to identify properties is still limited. You can't just go on like the MLS and say, I identify every single property in the MLS. So they have a couple of rules that you have to abide by. Okay. So the first rule can be what we call the 3 property rule. Okay. So you can identify any 3 properties without regard to their fair market value. Okay, so you can, let's say you're selling out of a $500,000 property and you want to get into an $800,000 property, you can identify up to 3 $800,000 properties. Okay, you could technically do a $1 million property, $1.5 million. You can do any amount of value as long as it's 3 properties or less. Okay. The second rule, if you don't want to do the 3 property rule, is you can do the 200% rule. Okay. So the 200% rule is that the exchanger can identify as potential, and during this identification period, they can identify as potential replacement properties any number of properties. Okay. As long as the fair market value of those properties does not exceed 200% of the fair market value of the relinquished property. Okay. So again, let's take our $200,000 or our $500,000 property that we're relinquishing. You can identify as many properties as you want, as long as the total value of those properties does not exceed $1 million. Okay. So we can see how realistically that is kind of that could be a tough thing to do, right? To identify a bunch of properties that are going to stay under $1 million in that case would be very difficult. So this might take place when, let's say, you're exchanging a $500,000 property out of Colorado, and let's say you're exchanging into a bunch of $100,000 townhomes in Wyoming or Kansas or something like that. That's where the 200% rule might come into play. That, hey, I'm going to exchange into 10 properties worth $1 million versus one property versus worth 800,000. Okay. The last rule is kind of, to me, it's a little more difficult to understand, and I've never used this rule, but the idea here is that if the exchanger identifies more replacement properties than is allowed either under the 3 property rule, which we talked about first, or the 200% rule, okay, then it looks as if the exchanger, they basically treat you as if no property replacement was identified, unless they actually they go under contract or close a replacement property by the end of the exchange period that's worth at least 95% of the aggregate fair market value of all the identified replacement properties. Okay, so if you identify 15 properties, you'd have to close on 95% of the value of those 15 properties. So when we're looking at 95%, for all intents and purposes, that's going to be every property that you identify. So that's why it's kind of a weird rule, because it says, you have to close on 95% of the properties that you identify. That's essentially all of them. And so you can only close on, whatever you have enough money for. So we really stick with those first 2 rules. So 3 properties or the 200% rule. Okay. All right. So those are kind of the logistics and the rules around how we identify a replacement property, how the exchange works going through like an intermediary, and really what the value is, which is, again, a full deferment of taxes. So keep in mind, this is not an exemption. This is just a deferment. We're kicking the can down the road. And so as long as we're 1031 exchanging the properties, we're saving that tax burden. And eventually we're going to have to pay it. Okay. But the point is, if you think about yourself, like if even with your income tax, if you could defer your income tax for 20 or 30 years and use the tax that you're saving to invest, think about the portfolio that you could build that would probably be enough to pay for your tax, your tax liability down the road or way down the road, in addition to having this big portfolio, right? So the idea here is that we're allowing people to build more wealth using taxable income and then get the taxes later in life. But as we've talked about in some prior episodes, including our previous episode, the last episode, there are ways actually to get out of a 1031 exchange on the back end by, for example, 1031 exchanging into this, a really nice, quote unquote, vacation home in Florida, renting it out for a couple of years, and then moving into the property. And now it becomes part of the personal property exemption. Okay, so there's lots of ways to kind of manipulate this. The other piece is again, the step-up basis that we've talked about before. If you never sell these properties, or you pass away with these properties in hand later in life, your heirs will get the step-up basis, and they're not going to have any of those capital gain deferments pushed back on them either, right? So there's some really powerful things here by kind of deferring the taxes. All right, so. Again, quick recap, 45 days to identify, 180 days for the exchange period to actually close on the property. And there is like a form that you fill out essentially for when you identify a property. Okay. The next thing I want to talk about is another piece that we can do with 1031 exchange, which is called a reverse 1031 exchange. And basically what this does is we still deal with timelines, but what happens is in the event that, let's say you're an investor and you're keeping your eye out for a property and you're being opportunistic and you find a great opportunity to invest, but you know that you're not going to be able to sell or you basically sell your relinquished property before you have the ability to purchase this other one, right? And so what we can do in this case, the other one is what we call a forward 1031 exchange. This is a reverse 1031 exchange, and this is where you actually acquire the property first. Now, reverse 1031 exchanges can be a little bit more difficult because there's a lot of regulation that runs around them on like the lending side. So reverse 1031 exchanges are not that big of a deal if you have the ability to buy the replacement property in cash. Okay. The same thing's going to happen is that you're going to buy the property in cash, but what you're going to do is you personally are not going to buy that property. You are going to basically talk with a qualified intermediary again that is going to purchase the property on your behalf into like an LLC using your cash. And they're going to hold the property so that it isn't in your name until you sell the relinquished property. Okay. And then once you sell the relinquished property, okay, then what happens is then we can pull that other property in, and the 1031 intermediary company is basically going to kind of sell that, quote unquote, sell that property back to you. So now what happens is the relinquished property technically got sold first before you receive the replacement property. Okay, so all that we're doing is we're acquiring the property, but somebody else is kind of holding it for us before it actually gets into our name. Okay, so like I said, there are some burdens that happen here. One of them, like I said, is having enough cash to purchase that property. And then the other thing is we still have the timelines. So that property, which we call a parked property. So once the 1031 exchange company purchases a property, we call that property a parked property. They can only hold that for 180 days. Okay. So again, we've got to make sure that the other property gets sold within that 180-day period. Okay, so the other problem that we run into again is the financing piece. So, in order for you to purchase a property, essentially in someone else's name, that you need a loan on, you have to find some very non-traditional financing. Okay. And the reason is that because most loans, okay, when we think about the loans that we get for purchasing our own property or purchasing our house, we get really standard kind of government-backed conventional loans. And those loans are what we call, recourse loans. So recourse loans basically say that you have the ability to, or the bank has the ability to go after you as an individual as recourse for default on the loan. Okay. A non-recourse loan, the only recourse that the bank has is the property itself. Okay. And so if a third party company is going to take on this debt that's technically yours, they are only going to agree to a non-recourse loan because they're going to say, hey, it's your loan, but because we're the ones that are technically holding it, we don't want to be personally liable for the payments not being made on this property. So they're not going to accept a recourse loan. They're only going to get a non-recourse loan. And non-recourse loans are a little bit more difficult and a lot more expensive than a normal recourse loan because the risk is a lot higher. Okay. So we run into a lot of issues if you're not a cash heavy investor that has the ability to buy property outright. Reverse exchanges can be really, really difficult. Okay. So again, we kind of get into the weeds with reverse exchanges. So again, if you are looking at, doing some type of reverse exchange or interested in learning more about reverse exchange, definitely getting with somebody that does, that specializes in these things is going to be very important. All right. Let's see. What else do we want to talk about with 1031? Okay. The next one I want to talk about is the ability to kind of refinance before and after exchanges. So one of the thoughts that people use to try to get around the quote unquote boot of a property is they say, all right, we bought this property for say $500,000 and we've paid down the principal. It's now worth $800,000. We only owe $350 on it. Okay. So what they do is they go, okay, so we have $450,000 in equity in this property. And if we exchange it, we have to use all 450,000 of it. So what people have thought to do is to refinance the property first. So do a cash out refinance, maybe pull 300,000 of that. Okay, now you only have 150,000 in equity. And the great thing about a cash out refinance is that that in itself is a non-taxable event. We've talked about that in prior episodes and how sometimes that's an exit strategy as we acquire more real estate. But people will pull out, say, $300,000, and then they'll do a 1031 exchange, and then they only have to move $150,000 into the new property, or basically move that $150,000 into new property. Okay. The problem is if you do these things too closely together, okay, then what can happen is that the exchange can result in a taxable transaction. So there's a thing that's, I can't remember, I think it's called like the step transaction doctrine. But basically what happens is that the IRS will argue that cashback refinancing immediately before an exchange is completed is just one step in many steps that result in not reinvesting all the equity from your relinquished property. Okay. So it basically will say, hey, your refinance proceeds are taxable now, and they'll come back after you for that. So we really want to kind of show that if we're doing a refinance, we want to show that when the refinance was executed, there was really no intent of selling the property. And then maybe a year later or 2 years later, that changed. The longer time that we have between the refinance and the exchange process, the more likely we're going to not have problems with the IRS saying like, hey, though that's a step transaction, right? And so what we do is, like, again, if you can refinance a year or 2 years before the exchange, you're probably going to be in better shape, right? Because again, we're not trying to find ways to sidestep the IRS. We're trying to find legal strategies in the tax code that allow us to defer or to completely abate taxes. All right. So it's very similar to the other side. So sometimes after you buy, so what happens is you go, let's say you have that same $500,000 property, you have $400,000 in equity. Okay. So what you do is you sell that $800,000 property, you reinvest in another $800,000 property. You move all your transactional funds into that property as a big down payment. And then 2 months later, you refinance and pull the cash out of that transaction. Similar with similar issues with that. Okay, so that one is probably a little better if you're gonna choose one. But again, my full disclosure here is that I'm not giving you tax advice. I'm not a CPA. To contact your tax advisor and find out about this tax law. But that's one of the things that we have to be very careful of. Is there are some different ways to maybe pull out some cash before you do a full exchange, but it's all about intent and what you're trying to do and what it's going to look like if you're put in front of a jury or you're put in front of a judge. Like, how are you gonna explain that? Okay, so again, a little bit less risky to refinance after the fact and pull that money back out than it is before. But those are just some of the ways that people kind of look at refinancing in order to decrease their necessity for a 1031 exchange and be able to pull out funds kind of tax-free. Okay. Now, again, the gain is still going to be deferred. So the capital gain is just by pulling funds out does not reduce your capital gain, because capital gain is calculated. It has nothing to do with how much you owe on the property. It has everything to do with your cost basis, what you acquired the property at, and your sale cost. So, when you sell the property, if it's $300,000 more than you bought it for, $300,000 is your capital gain. It has nothing to do with how much money you made, how much money you pulled out, how much money you had to pay off on the mortgage. It has everything to do with the actual difference between the acquisition cost and the sale cost. All right. So that's kind of 1031 in a nutshell. I think probably as best as I can explain it in about 30 minutes. And so this is the way that people defer taxes and kick that kind of can down the road, and then figure out ways to maybe even get those taxes to kind of float away with different strategies as well towards retirement and towards end of life, right? So it's very important to remember that 1031 is not a tax exemption. It's not a tax abatement. It is a tax deferment, so that we don't end up, or so that we do have the ability to reinvest the totality of the funds. Okay. We also need to remember that it's not very effective to exchange down. So exchanging from a $400,000 property to a $200,000 property is still going to leave you with a significant boot and a significant amount of tax, right? So anyway, those are the kind of the basics on 1031 exchange. I work with a handful of 1031 exchange intermediaries that I highly recommend. I've got a couple of resources that are fantastic when it comes to advising on 1031. So if you have any questions about your potential 1031 or how to go about exchanging properties or selling one of your investment properties, please reach out. Happy to answer your questions and get you connected with the right people. So that is it for today. Go out, go buy some real estate, understand the tax advantages of real estate, and exchange up, exchange often, use 1031 to your advantage, use the tax strategies to your advantage that we've talked about in the last 2 episodes, and remember to always live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.